Hello everyone, how's it going? Hope everyone's having a good weekend. There was some great games of football on today, especially that Aston Villa United game. Unbelievable, honestly. But anyway, that's me back into the full swing of things. Had my first live week this week. That week that just kind of passed. Um, so yeah. Anyway, I hope everyone else had a really good week as well. Now, I'm just going to speak briefly on the concepts of liquidity, okay, and I will go into sort of external and internal liquidity. Right now, I'll probably do another video sort of down the line at some point, maybe going into a bit more detail on the topics I'm speaking about today, right? But essentially, right, what we're going to see, let's keep that liquidity right there. Let's say we are on the 4-hour time frame, okay? The 4 hours making low lows, low highs, right? Now this is your external range high, your external range low. Essentially, these are your swings, okay? Now within these swings, right, let's say on a 15-minute time frame, we're going to have internal liquidity, right? So this is external liquidity, right? And once price essentially takes out external liquidity, it's going to gravitate towards internal liquidity. And once it's collected enough orders within those internal structures, then it will target the external ranges again, right? And that is the cyclical movement of price, right? That's how the price literally moves every day, right? So on a 15-minute time frame to get from this lower high to this lower low from a 15-minute time frame, I'll just make it red. We're gonna have something similar to this, right? Something like this perhaps, and we're going to get down to here, right? It's not just going to be a straight line down. So the 4-hour swings, they're your external ranges, right? What's within that, what's contained within that, right, in this instance the 15 minutes, will be your internal liquidity, right? Now this can be in the form of equal highs, it can be in the form of structural highs, right? It can be in the form of trend line, right? Anything, right? It can also be in the form of imbalances, right? So in this occasion, what we're doing is we've got equal highs. We've also got structural liquidity here, and we have, let's just say we've got some sort of, I just use this, some sort of imbalance right here, right? I'll just change that to red, right? So liquidity can be in the form of a lot of different things, right? What this is your cause for higher prices. That's your cause for higher prices. Okay, so we've got cause here, we've got cause here, we've got cause here for higher prices. Now, when you use liquidity and you combine it with structure, supply and demand, it's so powerful, right? Because essentially this is all what the movement is, right? This is all what the movement is, because price now needs to come up here to collect more orders and then get down, right? Now, with regards to which liquidity, which area is going to hold, etc., or which is, low resistance liquidity and high resistance liquidity, that's the kind of videos I would do sort of in the future, right? Now, what we're going to do from here, right? So after external ranges are created, price is going to navigate towards your internal liquidity, right? So we're taking out these equals, okay, fine. We're then taking out this structural liquidity, and we may even come back up to fill this imbalance, before, right? So now we've created, you know, what we've done is we've taken out the internal liquidity. And in doing so, what we've also done is create calls for lower prices, right? So this is now your calls for lower prices. So once all the internal liquidity, I don't want to say all the internal liquidity, once enough internal liquidity has been grabbed, right? So once enough orders has been grabbed, price is going to then navigate towards your external liquidity, right? Why? Because this has now become a weak low, right? So from here, once the internal liquidity has been grabbed, we're going to target this right here. And this is the movement that happens. Now, this here, by the way, it can be like this. It can be sort of, this can be a cause. So we can have something like this, right? It doesn't need to be like trend line or anything like that, right? It can be a double bottom right here, okay? And that can be your cause for low prices. Now, remember, like I said, you want to incorporate these concepts of liquidity with market structure, with supply and demand, so that you can build a really good case for taking a trade, right? And once you understand this, right, this is where you can really start to hedge and stuff as well, right? Because we know from here, price is going to target these internal ranges, so you can definitely buy into your point of interest up here to then look to sell again. Why are we looking to sell again? One, we've got calls, right? Two, we might already be in a downtrend, which in this case we are because we're making low lows, low highs. So we're looking to sell again, right? So we're getting in the pullback and we're getting the pro trend trade as well, right? So I'm going to move on to some examples in a minute. So guys, just quickly before moving on, I get a lot of questions with regards to what gets taught in the one-to-ones. So essentially, market structure. Start with market structure because structure is king, and then supply and demand concepts. How to really filter out your supply and demand zones, fair value gaps, entries. Right. So I'll speak to you about my entry models and risk management. Now, if you're completely new to trading or completely new to SMC, then obviously we'll tailor it towards that. But if you're looking for just that extra bit of information, that extra bit of education with regards to SMC, then we'll tailor it towards that as well. Okay, so that's pretty much it. Now let's get back to the charts. Right, so here's a few examples. Right, so this is an example in GBP USD, right, on the 4-hour chart. Okay, now same concepts, right? Let's just build a picture. We've taken out some sort of liquidity here, and we have broken structure. Completely fine, right? So our external, our swing ranges, that's the swing high, that's the swing low. Okay? Now, without point of interest, right, it can be, so remember, we need to add in some sort of supply and demand concepts in here. There's one point of interest. Your second point of interest, which is also a liquidity concept, is imbalance, right? So we can target 50% of the imbalance here as well. Now, this leg of price, if I jump down to the 15-minute, well, what do we have? We have equal lows sitting right here. Sorry, equal highs. Okay? We have structural liquidity right there. So we could definitely look to, right? And I'm not going to go into entries and stuff like that. But we could, knowing this, given our lower time frame confirmations, we could look to target these. Okay? That could be target 1, that could be target 2, and this could be potentially target 3. Right? Now, if I just play price out, what does price do? We're targeting these internal ranges, right? Because we need to go and collect more orders, right, in order for price to come to go where it wants to go, right? So what have we done here? We've initially taken this out. So we've taken this out, these equal highs, which is off his target. We've taken out the structural liquidity, and we've come and filled the 50% of the imbalance, right? Now remember, imbalance is a liquidity concept in itself. Price gravitates towards imbalances, okay? And in doing so, we're creating cause for lower prices, right? We're creating this trendline liquidity here, we're creating these staggered higher lows. So we're creating causes for for lower prices. So we had our causes for higher prices here, right? And once price collected enough orders, so essentially once price is collected enough internal liquidity, price is going to gravitate towards your external ranges, right? And that's when we can confidently say, right, we can target these levels here. Because what we're expecting, so this was a higher low on the 4-hour time frame. This was a lower low. This could potentially be a higher low. And we're targeting another lower low, right? That's our expectation. That's our expectational order flow, right? So if I just jump up to the 1 hour, just so this is a bit faster, and what do we get? We break the low, right? Now remember, same thing again. Let's just look at it from a 1 hour standpoint, right? I'll delete all this. So in this case, we've got a high, which created the low, right? I'll just play it back down to right there. What could we have as our point of interest? We could have potentially this here. We could have this extreme. And you could definitely have something in here as well, right? Completely fine. But like I said, using supply and demand concepts along with market structure with liquidity is when it really seems to work, right? Or is when it, when it works at its best. So let's just jump down to the 15-minute again, right? So the external range liquidity has been taken now. What we're looking at, cool. Right here, well, can we see? You can see this sort of staggered structure there. We can see, we can see structural liquidity right there, right below our zone, and right below the extreme we can also see these equals. Okay, so we've got our cause for higher prices. And what does price do? Price is naturally now going to gravitate towards higher prices. So what we've done is we've took out this external liquidity, right? We've printed a new low potentially, and now we're starting to gravitate towards our internal liquidity to then again collect enough orders from there or from here to then go down again, right? Which is our expectation, right? Our higher time frame expectation. So when you understand this, what you can do is look to buy from here, right? Because we're targeting these levels here, right? We're targeting at least for price to get to this level. Okay, and what does price do? We come to take out these internal liquidity ranges, right? We come to take out these internal liquidity ranges. Right, so I just played that forward, just so we're not wasting time. Now, so we've taken out this, we've taken out this. In doing so, what have we done? What have we done? We have created trendline liquidity, which is now going to be your cause for lower prices. Now going with the overall structure, which is downtrend, we've got a higher time frame supply zone. And if I just zoom in here, just quickly, we've started to break structure again on the 15-minute. So now we could look to sell so that price takes out this liquidity in the expectation that we print a new low, right? So this is how we can use external and internal range liquidity to our advantage, right? And especially when we're building that case study, that case to take a trade, right? Whether it be counter trend or pro trend, we can use these liquidity concepts to really add in that confluence, right? And what does price do? We grabbed enough orders internally, right, from this high to this low. We've grabbed enough orders, and then we've now come and printed a new low. And this is a cycle that just keeps repeating itself, right? So we looked at this example here, we looked at this example here. So guys, that's it for me today. Hope you guys took something from that video. Again, small concepts that we can use to build that story, to build that confluence while, planning to take a trade. So as usual, if you like the video, if you like the content here, please do give it a like, give it a share. And if you've not already done so, subscribe to this channel.